The Great Reset has started, and gold is the key to survive it. Have you ever considered that the financial system you rely on is operating on borrowed time, and that a silent, systemic shift is already underway to replace it? What if the frantic accumulation of gold by global central banks is not just a market trend, but the final signal that the era of paper money is drawing to a close? We are not witnessing just another commodity cycle. We are living through a fundamental rewriting of the global monetary order, a seismic event that will redefine wealth for generations to come. This is not a story about market speculation. It is about the end of a 75-year experiment with fiat currency and the inevitable return to real, tangible value. The clock is ticking, and the window to prepare for this transformation is closing far more rapidly than most people realize, as the foundational pillars of our economic world begin to crumble. The heart of the problem lies in a paradox that has defined Western economies for decades: the reliance on perpetual debt to create the illusion of prosperity. The United States, as the issuer of the world's reserve currency, has been the primary architect of this system. Its national debt has spiraled to levels that defy mathematical sustainability, now far exceeding 120% of its gross domestic product. History provides a stark warning about this milestone. As far back as the 18th century, economist David Hume observed that once a nation's debt crosses the 100% threshold, its economic growth is mathematically destined to slow by as much as a third. There is no longer a path to grow our way out of this crisis. The sheer scale of the obligations means that the only tool left for policymakers is currency debasement, a polite term for relentlessly printing money to monetize the ever-expanding mountain of debt, effectively stealing purchasing power from every citizen. The catalyst for the impending global reset was an act of political desperation that irrevocably shattered the illusion of the US Treasury bond as the world's risk-free asset. When the United States weaponized the dollar and its treasury system in 2022, it sent a shockwave through the international community. For decades, foreign nations held U.S. debt as their primary reserve, believing it to be a sanctuary of safety and stability. That trust has been permanently broken. Global central banks, particularly those in the East, recognized this moment as a critical turning point. They understood that their national wealth, held in the form of promises from a nation drowning in its own debt, was no longer secure. This realization triggered a quiet but deliberate pivot, a strategic retreat from paper assets and a massive, coordinated accumulation of physical gold, the one asset that carries no counterparty risk and cannot be devalued by a printing press. We have now crossed the tipping point, the moment where this paradigm shift becomes an irreversible force. For the first time since the mid-1990s, the world's central banks collectively hold more gold in their reserves than they do US Treasuries. This is not a random fluctuation. It is a clear and calculated verdict on the future of the dollar. Nations like China have been systematically divesting from their US debt holdings, reducing their exposure by over a quarter since the weaponization of the financial system, while simultaneously absorbing thousands of tons of gold. This massive influx of the monetary metal into sovereign vaults is not being done for speculative gain. It is the meticulous construction of the foundation for a new international trade settlement system, one where transactions are ultimately backed by tangible assets, not the hollow promises of a hyper-indebted nation. The world is quietly preparing for a post-dollar reality. The immediate impact of this global realignment will be a violent repricing of assets, particularly gold and silver. As faith in fiat currencies continues its terminal decline, gold is re-emerging not as a commodity, but as its ultimate historical role, the foundation of real money. The surge towards $7,000 gold is not a matter of retail speculation. It is being driven by the largest and most powerful financial institutions in the world, the central banks. They are methodically reclaiming gold's position as the ultimate strategic reserve asset, a final protection against the systematic debasement of currencies worldwide. This movement signals that the world is entering an era where trust in paper is rapidly evaporating, forcing a confrontation with the reality of decades of fiscal irresponsibility. The coming years will not be about a simple bull market in precious metals, but a full-blown reset of the global monetary order. In this new landscape, silver is poised to deliver a truly extraordinary performance. Often dismissed as the poor man's gold, its unique characteristics make it a critical component of this monetary puzzle. Silver carries both a historical monetary role and an irreplaceable industrial one. As confidence in paper money collapses, the demand for a more accessible and divisible store of value will surge. Furthermore, the silver market is astonishingly small. Its entire market capitalization is a fraction of a single large technology company. This means that even a small shift in investment demand, which is already happening, can have an explosive impact on its price. The paper manipulation schemes that have suppressed silver's value for years are breaking down, as the physical supply deficits become too severe to ignore. The historical gold-to-silver ratio is destined to compress, suggesting that silver's rise could dramatically outpace that of gold. The inevitable consequence of this monetary reset for the average citizen is a painful but necessary reckoning with reality. The system of financial repression, which has defined Western economies for years, will become more overt. This is a strategy where governments, in collusion with central banks, deliberately hold interest rates below the true rate of inflation. The result is that any money held in government bonds or savings accounts is guaranteed to lose purchasing power over time. It is a constructive, silent default on their obligations. They will continue to publish manipulated inflation statistics that bear no resemblance to the lived experience of ordinary people, who see their costs for housing, food, and energy skyrocket. This widening chasm between official narratives and the reality on Main Street is the final, crumbling stage of a debt-saturated system. The structural decay is now evident across the entire economic landscape. We have been in a de facto recession since 2022, a fact obscured by manipulated government data. The warning signs are everywhere for those willing to look past the headlines. Delinquency rates on consumer credit are at 13-year highs, private credit scores are dropping at a historic pace, and over half of all U.S. companies are reporting negative profit margins. The labor market, often touted as a pillar of strength, is showing deep cracks, with nearly 1 million jobs having been revised away and planned hiring plummeting. Major retailers are forecasting the worst holiday season since the 2008 financial crisis. This is not a temporary downturn. It is the mathematical result of a currency losing its value, where wages can no longer keep pace with the relentless debasement required to service an unpayable debt load. The question of America's own gold reserves looms large over this entire transition. While official records claim the United States holds over 8,000 tons of gold, there has not been a comprehensive, independent audit in decades. This lack of transparency is a source of profound strategic vulnerability. Rivals like Russia and China are widely believed to possess far more gold than they officially declare, having been quietly accumulating it for years. As the world pivots toward a system where gold plays a central settlement role, the nation with the most gold will hold the most power. A return to any form of a gold standard in the U.S., while fiscally prudent, is politically impossible in the short term. It would act as a chaperone on government spending, forcing the kind of austerity that no elected official is willing to impose. It would mean the end of deficit spending and the unlimited printing of money to fund every government program. Therefore, the United States finds itself in a strategic bind. It cannot embrace a gold standard without first revealing the true state of its reserves, which are likely far less dominant than they were in the post-war era. Meanwhile, its geopolitical adversaries are not waiting for an invitation to create a new system. The BRICS nations have already signaled their intent to build a trade framework where gold serves as a neutral settlement asset, bypassing the dollar-dominated system entirely. They do not need to create a gold-backed yuan or ruble overnight. Instead, they are waiting for the American system to implode under the weight of its own contradictions. When that moment comes, they will be positioned to push the button on a new monetary order, one in which their vast, audited gold reserves grant them significant influence. The slow, steady decline of the dollar's hegemony is not a speculative theory. It is a visible geopolitical strategy unfolding in real time. The retail investor, for the most part, remains dangerously unaware of the magnitude of this shift. For decades, they have been conditioned by mainstream financial advisors to view gold as a volatile, archaic relic. They have been told to trust in a diversified portfolio of stocks and bonds, the very paper assets that are most at risk in an era of currency debasement. Astonishingly, over the last quarter century, gold has actually outperformed the S&P 500, yet its allocation in global portfolios remains at a minuscule 0.5%. The historical average is closer to 2%, and it reached as high as 8% during the inflationary crisis of the 1980s. A simple reversion to the mean would unleash a tidal wave of retail demand into a market that is already strained by immense central bank buying. This retail awakening has not even begun in the West, but when it does, it will act as a powerful accelerant for gold prices. We are witnessing a great decoupling, where the price of gold is no longer tethered to its traditional inverse relationship with the US dollar. In the past, a strong dollar often meant a weaker gold price, and vice versa. That correlation has been shattered. Today, gold is rising against all fiat currencies, including a relatively strong dollar. This signals that gold's strength is not about short-term currency fluctuations, but about a profound, global loss of faith in the entire system of unbacked paper money. The dollar may remain the strongest horse in the glue factory for a time, propped up by its role in global trade finance and debt denomination, but its fundamental value is being relentlessly eroded. Investors are beginning to understand that they need to save in an asset that holds its value, like gold, while they spend in depreciating local currencies. This transition is not a prediction. It is an observation of a process that is already well underway and gaining unstoppable momentum. The first phase was the quiet realization among a few that America's debt was unsustainable. The second was the overt weaponization of the financial system, which forced the hands of global powers. We are now in the third phase, where the consequences of these actions are becoming visible to all. Central banks are dumping treasuries, the BRICS nations are building an alternative system, and major investment banks are finally admitting that gold deserves a significant place in any portfolio. The headlines are catching up to a reality that has been developing for years. This is history unfolding, a fourth turning where the old order gives way to a new one, built not on promises but on the enduring foundation of real assets. For those who feel they have missed the opportunity to protect their wealth, who see the price of an ounce of gold as increasingly out of reach, silver represents an incredible opportunity. It is a fat pitch in a world of financial uncertainty. The supply and demand fundamentals for silver are overwhelmingly bullish. There are clear and persistent deficits in the physical market, meaning that industrial and investment demand is consistently outstripping what is being mined and recycled. The technical chart for silver shows a massive 45-year consolidation pattern that is poised for a historic breakout. It is massively undervalued relative to gold, and as history has shown, when a secular bull market in precious metals takes hold, silver's performance is often nothing short of extravagant. It is the speedboat that races past the juggernaut of gold. The path forward will not be a straight line. There will be volatility and pullbacks designed to shake out weak hands and discourage participation. Many investors will remain on the sidelines, waiting for a significant price drop that may never come or may come from a much higher level. Waiting for the perfect entry point is a fool's errand in a shifting paradigm. The goal is not to time the market for short-term gains, but to acquire a long-term position in sound money as insurance against the slow, certain death of fiat currencies. The risk is not in owning gold and silver at these prices. The true risk is in having zero exposure to the only form of money that has survived every financial crisis for 5,000 years. The debasement of our currency is not a bug in the system. It is the system itself, and its endgame is now approaching. The ultimate takeaway from this unfolding revolution is the timeless lesson of monetary history. Every experiment with unbacked fiat currency has ended in failure. From the Roman denarius to the Weimar mark, the temptation to solve political and economic problems through the printing press has always led to ruin. We are now in the final chapter of the great US dollar experiment. The coming years will mark a painful but necessary rebalancing, a return to a system where value is defined by scarcity and trust, not by government decree. Gold and silver are not merely investments, they are the lifeboats in a currency shipwreck. The shift is no longer a distant possibility, it is a present reality. The choice is whether to acknowledge this reality and prepare for it, or to ignore it and face the devastating consequences. The current gold bull market, already over 700 days old, is exhibiting all the classic signs of a historic rally with years left to run. Historically, these major cycles last well over 1,000 days, suggesting we are still in the early to middle stages of this powerful uptrend. What distinguishes this rally from previous ones is its driver. This is not a surge fueled by speculative retail fervor. It is a structural shift led by the world's central banks. These institutions are methodically accumulating gold not as a trade, but as a strategic rebalancing of their reserves. They are moving away from assets that represent a claim on a debt-based system and toward an asset that is the foundation of a value-based system. This institutional demand creates a powerful and resilient floor under the gold price, making any significant pullbacks short-lived and providing a strong base for the next leg higher. The narrative that gold is too expensive is a persistent fallacy that keeps many investors on the sidelines, to their own detriment. People said gold was too expensive at 1,600, at 2,000, and they will say it is too expensive at 5,000. This thinking misunderstands gold's fundamental role. It is not an asset you buy for rapid appreciation, but a monetary instrument you hold to preserve purchasing power over time. Its rising price in dollar terms is not a sign of gold becoming more valuable. It is a sign of the dollar becoming worthless. Every upward tick in the gold price is a measure of the silent theft of inflation and currency debasement. When viewed through this lens, the only expensive choice is to hold one's wealth entirely in a depreciating paper currency, waiting for it to lose even more of its value. The manipulation of the precious metals markets through paper contracts on exchanges like the COMEX is a well-documented phenomenon that has suppressed prices for years. However, the ability of this paper cartel to control the market is rapidly diminishing. The physical constraints are becoming too powerful to ignore. The COMEX is running dangerously low on physical silver to deliver against its contracts, and the available float of silver ounces in London is barely enough to cover a single day's trading volume. As more investors demand physical delivery and pull metal out of the system, the leverage of the paper shorts is broken. The recent ability of silver to push higher despite massive short positions is a testament to the growing power of physical demand over paper promises. The breaking of this manipulation will unleash decades of suppressed price potential. China's role in this global monetary reset cannot be overstated. While officially reporting modest increases in their gold reserves, the reality is that the nation has been absorbing colossal amounts of gold through various channels for over a decade. China is not just preparing for a post-dollar world, it is actively building the architecture for it. By reducing its reliance on US Treasuries and anchoring its own system more closely to gold, it is positioning the yuan as a credible alternative in international trade, at least regionally. China does not need to announce a gold-backed currency to achieve its goals. It simply needs to continue its current path, allowing the US to weaken itself through internal debt and currency debasement, and then step forward with a more stable gold-linked system when the time is right. This is a long-term strategic game, and China is playing it masterfully. The argument that the US can simply grow its way out of its debt crisis is a dangerous fantasy. With debt-to-GDP ratios far exceeding the critical 100% level, the mathematical reality is one of permanently suppressed growth. High debt levels act as a tax on future productivity, diverting capital from productive investment towards servicing old obligations. The only remaining path to manage this debt is through financial repression and inflation. This means the government will continue to lie about the true rate of inflation while holding interest rates artificially low, guaranteeing that savers and bondholders lose money in real terms. This is not a theoretical model, it is the openly stated policy of central banks. It is a slow, methodical transfer of wealth from the public to the state, and it is the primary reason why holding tangible assets outside of this system is no longer a choice, but a necessity. We are witnessing a historic divergence between the financial markets and the real economy. While asset prices have been inflated by relentless money printing, Main Street is experiencing a significant decline in living standards. This is the predictable outcome of currency debasement. The purchasing power of the dollar is eroding faster than wages are rising, leading to a silent but profound economic hardship. The official unemployment and inflation figures are statistical creations designed to paint a rosy picture, but the reality is felt in every household budget. The increase in credit card debt, auto loan delinquencies, and corporate bankruptcies are not signs of a healthy economy. They are the symptoms of a system that has sacrificed real prosperity for the illusion of it, funded by an ever-expanding supply of worthless currency. The concept of de-dollarization is often misunderstood. It does not mean the dollar will disappear or become worthless overnight. It means a slow but steady decline in its global dominance and a repricing of its value. For decades, the world was forced to use and hold dollars, which allowed the US to export its inflation and fund its deficits. That era is ending. The rise of multipolar trade blocs and the creation of alternative payment systems are chipping away at the dollar's hegemony. Nations are increasingly choosing to trade in their own currencies or settle balances with neutral assets like gold. This reduces the global demand for dollars, meaning that more of those printed dollars will stay at home, further fueling domestic inflation. The dollar will still have a role, but it will no longer be the unquestioned king. The political will to address the fundamental problems of debt and spending is completely absent. Any politician who proposes the necessary austerity measures, cutting entitlements, reducing defense spending, and living within the nation's means, would be committing political suicide. The system is designed to reward those who promise more spending and more benefits, paid for with borrowed or printed money. This creates a doom loop where the problems only get worse, and the solutions become more radical. Because the political path to fiscal sanity is blocked, the only remaining outlet is a monetary one. The debt will be dealt with not by paying it back, but by destroying the value of the currency in which it is denominated. This is the final, tragic act of every fiat currency system in history. The mainstream financial media and advisory industry have largely failed to prepare investors for this paradigm shift. Their models are built on the assumption that the past 40 years of declining interest rates and stable inflation will continue indefinitely. They are structurally incentivized to keep clients invested in the stocks and bonds that generate fees, regardless of the underlying risks. They dismiss sound money advocates as fearmongers, while ignoring the clear historical and mathematical evidence that the current system is unsustainable. Even now, as major institutions like Morgan Stanley begin to recommend a 20% allocation to gold, the average advisor remains years behind the curve. This creates a once-in-a-generation opportunity for independent thinkers who are willing to look beyond the conventional wisdom and position themselves for the inevitable reset. The psychological barrier to buying precious metals is significant, especially after a long period of apparent stability. It requires a fundamental shift in thinking, from viewing money as a tool for speculation to understanding it as a store of value. It means accepting the uncomfortable truth that the institutions you have been taught to trust are actively devaluing your savings. For many, this is a difficult and frightening realization. However, history shows that those who act on this realization before the crisis becomes obvious are the ones who not only survive but thrive. The time to acquire insurance is before the fire breaks out. Waiting for the full-blown collapse of confidence is waiting too long, as by then, the very assets you need for protection will be unobtainable for the vast majority. Looking ahead, we can predict a future where the international monetary system becomes more fragmented and multifaceted. The single-pole system dominated by the US dollar will give way to a multipolar world with several regional currency blocs. Trade between these blocs will increasingly be settled not with a single nation's fiat currency, but with a neutral, universally accepted asset. Gold is the only candidate that fulfills this role. We are not heading back to a classical gold standard, where currencies are directly convertible into gold at a fixed price. Instead, we are moving toward a system where gold acts as the ultimate arbiter of value, a final settlement layer that disciplines the entire financial system. Its price will not be fixed but will float, reflecting the relative faith in the various paper currencies it is measured against. For individual investors, the strategy should be one of profound simplicity. It involves systematically converting a portion of one's depreciating paper assets into real, tangible wealth. This means owning physical gold and silver, held outside of the traditional banking and brokerage system to the greatest extent possible. This is not about day trading or trying to time market swings. It is about building a long-term position that will act as a permanent store of purchasing power through the coming turmoil. It is about owning an asset that has no counterparty risk, cannot be hacked, and whose value cannot be inflated away by government decree. In a world of increasing complexity and systemic risk, the ultimate sophistication lies in the ownership of real money. The coming crisis will also be a crisis of trust. As people realize that the value of their money, their pensions, and their savings has been systematically eroded, there will be a profound loss of faith in institutions, both governmental and financial. This erosion of trust is already underway and will only accelerate. The appeal of gold and silver in such an environment goes beyond their financial characteristics. They represent something real and enduring in a world of digital promises and political deception. They are a form of wealth that is independent of any government or financial system, a personal declaration of monetary sovereignty. This intrinsic appeal will become increasingly powerful as the existing order continues to unravel. The extravagant, though infrequent, rewards of silver that market veterans speak of are rooted in its unique market dynamics. Because the market is so small and has been subject to such intense paper manipulation, when the tide turns, the reversal is incredibly violent. The combination of a supply deficit, record investment demand, a breakout from a multi-decade technical pattern, and the breakdown of the paper suppression scheme creates the potential for a truly explosive move. A return to its inflation-adjusted all-time high would put silver at a level of at least 150, a multiple of its current price. For those with patience and a clear understanding of the underlying forces at play, silver offers a speculative potential that is unmatched in today's financial markets, coupled with the safety of a real physical asset. Ultimately, this is not just a gold story or a silver story. It is the story of the end of a monetary supercycle. It is a full-blown reset of the global financial architecture. As faith in fiat currencies collapses under the insurmountable weight of debt and decades of broken promises, gold and silver are simply stepping back into their natural historical positions as the true measures of wealth. This is not a radical or new idea. It is the recurring final chapter of a story that has played out countless times throughout history. We are simply living through the latest iteration. The system is finally being forced to confront reality, and in that confrontation, real value will always prevail over illusion.